Hi there, this is Alvin from Dr. Wealth. Warren Buffett pens a letter for his shareholders every year and is full of investment insights. So in his 2022 letter, I'm going to distill the insights into 4 main lessons for you. So lesson number 1 is that be business pickers, not stock pickers. It's easy to confuse between stock price and the business value. They are not the same because stock price can fluctuate while the business value can be steady. This is because stock price is driven by investor sentiments, a lot of assumptions and perspectives about how a business will perform in the future. So it tends to be very volatile, and that causes a lot of emotional swings in the investor if you really focus on the stock price too much. And I guess it's also because stock price is readily available, it's easily accessible, such that most investors will focus on the stock price movement rather than the business value. Business value is usually determined from the financial statements that's being reported every quarter for a business, and that's where you can gain insights how the business is performing. And you can have a case where business value has gone up but the share price have came down. And in the short run, the share price has little correlation with business performance, but in the long run, the share price would correlate very strongly with the overall business value growth. So that is why it is better to focus more on the business rather than on the stock itself. Because if you get a business right, eventually the stock price would follow to give you the financial reward that you're after. Brian Ferrodi has a very nice chart that depicts the relationship between the business value and the stock price. So you can see in the chart itself, the business can grow steadily over the years, but the share price can overextend on the high side and it can overextend at the downside as well. So that volatility, which is the fluctuation of this stock price, will cause a lot of uneasiness in stock investors. So if you focus too much on the stock price, that can affect how you decide when to buy and sell. And we all know that when you use emotions or the greed and fear would cause you to buy and sell at the wrong time. If you focus on the business value, you might have a much calmer effect on you, and you should be able to make better investment decision from there. There's a solution to it, and this is what Buffett has written in his shareholder letter. The company's operating earnings, our term for income calculated using GAAP, exclusive of capital gains and losses from equity holdings, set a record of 30.8 billion. Charlie and I focus on this operational figure and urge you to do so as well. The GAAP figure, absent of our adjustment, fluctuates wildly and capriciously at every reporting date. So you can see that his solution or his suggestion is for you to focus more on the growth in operating earnings. And again, this data is from the financial statements, and of course you do need skills to learn how to interpret them, but it is not something that is rocket science. Okay, I believe that as long as you understand the logic of the main accounting principles, you will be able to do it. And this is a table where Buffett wanted to show the differences in the operating earnings as well as the GAAP earnings that they are supposed to report, which includes the gains and losses of their investment due to the change in share prices. You can see the middle column, the operating earnings have been like 7 billion, 9.3 billion, 7.8 and 6.7 for the 4 quarters in 2022. And then if we look at the GAAP earnings, it really fluctuated a lot from 5.5 billion to a loss of 43.8 billion, then a 2.7 billion loss, and then another 18.2 billion gain. So you can see if let's say you really go through this up and down at very big magnitude, it's really very easy to lose your mind. Okay, so that is why Buffett continued to emphasize that focus on the business value. So to conclude, lesson number 1 is that when you review your stock holding, when you review your portfolio, maybe instead of just looking at the share price fluctuation, the value of your investment in terms of its share price, focus more on the fundamentals, right? Have the business grown in value? Okay, did the revenue grow? Did operating income grow? Did the net income grow? Did the earnings increase? Did the cash flow improve? Or did the market share increase as well? So there are many ways to evaluate the fundamental value, right? So of course, Buffett did talk about operating income as one of the key measures, but that is just one of the many that you can look at. So as long as your business has been growing from strength to strength, then you should continue to hold it. Eventually, the share price will reflect the fundamental value of the business that you own. Lesson number 2, few big winners are enough to make a fortune. Okay. So Warren Buffett in his 2022 letter, he did highlight 2 exceptional businesses that he wanted to show how they drove majority of the returns. So this was what he said in the shareholder letter. Our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. So he's saying that even though Warren Buffett is known as a very exceptional stock picker, he did modestly admit that majority of his investments are just meh. Okay, it's not something that's very fantastic. The only difference is that a few of these picks really became very exceptional, that really drives his return and able to beat the index handily. So this is similar to the Pareto principle or the 80-20 rule. Essentially, it's saying that minority of the investment drives majority of the returns in the portfolio. So it is going to be the same for every one of us. Okay, so there will be a few investments that will make the difference, and majority of them will just fade out. But that doesn't mean that we can or we should just be frivolous with our selection. If you decided to be a business picker, do your best in evaluating every business and pick the best that you can and form a portfolio of these businesses. But that said, it doesn't mean that every business will work out, every business will give you a success. Sometimes we'll get it wrong, and which means that it is necessary to accept failures and also, more importantly, admit the mistakes and see how we can improve in picking better businesses in the future. Lesson number 3, dividend growers are great investment. He didn't really say that explicitly, but this was a lesson that I gleaned from his writing in the 2022 letter, and he did mention about Coca-Cola and Amex. And just nice that these two are also dividend growers. So let's go to it. So for Coca-Cola, Warren Buffett via Berkshire Hathaway bought it in 1994 with a $1.3 billion stake. And in 2022, they received a $704 million dividends. Okay, so that itself based on the yield on cost, right? If you take just the 2022 year alone, $700 million divided by 1.3 billion, the buy price, he has a dividend yield of 54%. That is really exceptional. And that's only just 1 year, right? Last year, he probably also get about 50% dividend yield and so on and so forth. And going forward, there is more dividend to be collected. So he have definitely taken back his capital via this dividend distribution and more. And the next example he gave was Amex, and he bought it in 1995 at a $1.3 billion stake. And in 2022, it received $300 million in terms of dividends. So the dividend yield is 23% based on its buy price. So again, a very fantastic rate of return just by dividend alone. Okay, also have taken back his capital and more. And going forward, if he continue to hold this, his dividend is going to increase every year as well. So dividend growers have such profile, right? You can see that if you chart out their dividend per share over years, you will see that there's this very consistent growth in their dividend per share. And that is in tandem with the growth rate of the business itself. And it can be either the revenue growth, or it can also be the margin expansion that result in the company having more cash to give out to the shareholders. So when this dividend increase, you will realize that you don't need to do much, right? You actually get a pay raise for your passive income without doing anything. That's better than climbing the corporate ladder. So that is why I do think that dividend growers are one of the most underrated long-term investment that investors could have looked at. But dividend is not just the only return. Don't forget about the capital gain. So Warren Buffett did say that these dividend gains, though pleasing, are far from spectacular, but they bring with them important gains in stock prices. So for example, Coca-Cola, so for $1.3 billion, he bought it in 1994, it has become $25 billion in 2022. That's an 18 times return. And it's just capital gain. We haven't counted the dividend gains that we mentioned just now. And for Amex, $1.3 billion became $22 billion in 2022, and that's a 16x return. And this is what he meant by just focusing on these few winners, he was able to generate a big return for his overall portfolio. That said, it doesn't mean that a business must always give a dividend before you invest, okay? Because at the end of the day, it's still the business quality that matters, okay? It is a business fundamental and how sustainable the growth can be going forward. And investors need to get that right? You want a quality business that can grow in value in, year out, good times or bad times, and that is the true skill of the investor. It's the qualitative aspect of the business analysis that enable you to pick the right one. Lesson number 4, bet on America, not against it. So we know that majority of Warren Buffett investments are in the US. Rarely he venture out of the US in other countries. He does have some for overseas investment, but they are usually the smaller investment. The bigger ones are usually in the US. So this is what he said in the letter. I've been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I have yet to see a time when it made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. So he does really believe that the US dominance will carry on for the next few decades at least. It is unlikely China is going to just take over the throne and become number one, and US will just downfall from there all the way, right? So he believed that US will hang on to the power for a much longer time. That's why investors cannot just exclude US investments in their portfolio. And we take a look like today's the most important companies, the biggest company in the world, and by market cap, majority of them are from the US. Okay, this is by market cap, and if based on revenue, which is tracked by the Fortune Global 500, you see that yes, there are some Chinese companies coming up, but majority of them are still American companies. So that power is not easy to take away overnight, and that's why investors will still find a lot of high quality businesses in the US to invest in. So these are the 4 lessons that I have gleaned and distilled for you in this video. So number 1 is that be business speakers. Focus on the business fundamentals, the business value. That is the steadier metric to look at. And over the long run, if you get this metric right, you will be able to reward with higher share price. Okay, so the trick is not to focus so much on the share price movement to spook you out when the price fluctuates too much. Lesson 2 is that few big winners can make a fortune. Okay, so expect that there will only be a few investments that will deliver majority of returns to your portfolio. That is how the world works. Okay, it's non-linear, it's exponential in nature. So it is important to hang on to these exceptional winners. But in order to have these few exceptional winners, we do have to raise the bar, right? We do have to put in our best to find the best businesses that we can buy in the portfolio. Okay, so then the chances of finding these few exceptional businesses will increase. Number 3 is that dividend growers are great investments. Okay, he didn't specifically say that, as I mentioned, but the 2 examples of where the majority of returns were delivered to Buffett's portfolio were dividend growers, Coca-Cola and Amex. And the beauty of these dividend growers is that you enjoy pay raises every year without you doing additional work. And on top of that, the capital gains will be tremendous, right? So you get the best of both worlds, you get cash flow, and you also get huge capital gains at the end of the day. So that is why I do think that dividend growers are very fantastic investments, but dividend is not a key criteria before you invest in a counter, right? It's still the quality of the business that matters, which relates to point number 1 again. Then number 4 is that bet on America, not against it, okay? Because a lot of the best businesses are still residing in US. So you'll be foolish to just ignore them altogether, right? There can be very exceptional investments that may be the key ones that drive the portfolio value for you in the next few decades. So again, that relates to point number 2, right? So few big winners will drive majority of returns. Okay, so you want to go where your chances are the highest, and US definitely is still one of the best places to hunt for the exceptional businesses. So I hope you enjoyed the video. Now you're armed with more insights how to approach the market. Do like this video, subscribe to the channel, and I'll see you in the next one. Goodbye.